Good evening and welcome to Business 7. This week we look at the budget from various angles. So joining us in the studio a bit later will be Dylan van Wyk from IJG Securities, and he's going to specifically focus on debt, how we're going to finance the deficit, and of course, what is the impact of a government's decision to increasingly rely on the domestic market to fund the deficit. What will that impact be on the pension fund industry in Namibia? Also, our infographic this week, if you want to see how government intends to focus on development for the next 3 years, we have a visual analysis of the development budget. Also in the program a bit later, we speak to Mario Poolman. He is the head of customer strategy at Nedbank Namibia, and he talks about all kinds of innovations. Stay tuned. It's been a week since Finance Minister Ipumbu Shimi tabled the new budget in Parliament, and analysts have had a good chunk of time to really have a look at the figures and tell us what is really happening behind the scene. Joining us is Dylan van Wyk. He is an analyst at IJG Securities. Good day, Dylan, and thank you for joining us.
Hi, Joe. Thanks for having me.
Beside everything else in the budget, I think there are mainly three questions that the man in the street has. That is, why is the deficit so big? And are we worried about the increasing debt? And then thirdly, where is the money going to come from? If you can quickly summarize or just put in a nutshell for us what the situation with the deficit is, and probably how did we get there?
Okay, Joe, for the last couple of years, we've been running budget deficits, not very large budget deficits, around 5% of GDP, which is normally quite healthy. However, our economy has been stagnating for a number of years. I think about from 2016, we've seen very little growth in the Namibian economy, and we've just had to borrow more as that revenue hasn't been coming through. Now, COVID has just hit us at the most inappropriate time. So in this current budget year that's passed, we've seen a heavy increase in expenditure, COVID related, as well as decreasing revenues due to lower tax incomes and just the economy as a whole just performing weaker. So this year's budget deficit was the largest one we've seen by far, but I think the more worrying thing that we're looking at is the next 2-3 years, where we don't see that budget deficit shrinking by much. So yes, on our way here, we've been in a recessionary environment and seen that debt accumulate over the last couple of years. But now we're really in a tough scenario where we have to borrow just to cover our basic expenditure.
Dylan, the ordinary man, we hear terms like debt trap and really scary terminology flying all over the place. What, in layman's terms, is a debt trap? And is Namibia working towards a debt trap?
Well, at the risk of being sensationalist, I think we really need to have a tough discussion. Where we are at the moment, we're spending more and more of our revenue on interest costs. So at the current budget year, 2020-21, we stood at about 14%. We're going up to 16%, and that's slowly moving to the 18% of revenue, which we are spending just on covering our interest costs. So that means roughly a sixth of our revenue is already spent just paying off our debts. Then we also have to look at the government wage bill. Of our revenue, that's another 55% this year. In other words, 71% of our budget has already been spent now. That leaves very little to allocate. And as we don't see much growth in the next 3 years, our revenues will remain under pressure. I think one of the major stumbling blocks was SACU revenue, which we saw revised down drastically. I think that will remain under pressure, and we've warned for many, many years that SACU revenue shouldn't be spent on recurring expenditure. It's not a given. That formula can be revised very easily, and we might lose a chunk of it. And now we're in this scenario where our expenditure is just running away and our revenue is under pressure. So yes, I think there is a risk of a debt trap, especially seeing as we're spending so much of our revenue just covering it. That debt pile is just growing and growing, and so is our interest costs. And if you look at the budget documents closely, you'll see that the percentage interest costs implied by the forecasts is decreasing over time, which doesn't make sense to us. Normally, as you accumulate debt, you become less creditworthy and your interest rate goes up. So I think there's a risk of also just under forecasting on that line item specifically. So I think, yes, we are in the risk of falling into a debt trap where we have to borrow money to pay more interest.
Over the last year, it has become normal to hear debt as a percentage of GDP, huge percentages internationally. Namibia going up to 70-80% of GDP over the next 3 years, and the public is sort of soothed by arguments saying debt to GDP of 80% is perfectly fine for Namibia because there's countries that have 100%, etc. Can we really afford or sustain debt to GDP of that magnitude?
I think, first of all, it's important to remind people that those 100% GDP countries are developed economies.
Exactly.
That's the US and Japan.
Exactly.
They also have ridiculously low borrowing costs. They've been sitting with almost no inflation for the last couple of years. So they can afford to borrow that kind of money. What's also very important is what those deficits are spent on. So if you borrow money, you need to put it into productive assets, which are going to grow your economy in the long term. Currently, what we're doing is we're borrowing to pay salaries. And we're borrowing to keep the show running. Our spending on the development budget is below 10%, or roughly around 10%, which is not sustainable in the long term. It should be around 20%. So if we're borrowing money to put it into productive assets, which are going to grow the economy and provide jobs in the future, then yes, higher debt levels can be sustained. But the way we're going now, it's an unsustainable scenario.
Yes, I sometimes, or when I read the latest budget and listened to the minister, I couldn't help but think that it sounds like a lot of consumers who is using one credit card to pay off the other credit card. I sort of got visions of, just swiping along to try and cover the other debts. Dylan, the huge question on everybody's mind is, how are we going to finance these deficits? The minister has indicated that he wants to taper down foreign exposure and increasingly rely on the domestic market. Can we do it that way?
If we look at the budget documents, we're looking at roughly 48 billion that government is trying to raise over the next 3 years. Compared to our contractual savings pool, that's pensions and long-term insurance fund, that's about 220 billion, I estimate. And I just don't know where it's going to come from, to be very, very honest. Unless we open up our markets to foreign investors that might be interested in our bonds, I just don't see our savings pool being able to cover that amount of debt. One thing that we are almost certain will happen in the next couple of years is we'll see the local asset requirements increase. But even with a measure like that, it's going to be very, very difficult to raise these large amounts of debt. especially the shorter term debt that needs to be rolled over year by year, your TBs and such. So I think what we really risk is seeing government bringing more and more bonds to auction, and those yields steadily climbing. And then that's just going to push up the funding cost.
Yes.
So it's a very, very large supply of bonds and TBs coming to market.
If one talks about increasing the asset requirement, that of course in layman's terms would mean that your big asset managers will be forced to invest a bigger chunk of the pensions in Namibia and not outside. The normal man in the street wants to know, very simplistically, is my pension in jeopardy? Is it? Am I going to get a lower yield? What is your take on that?
Well, I think we have to look at what type of Namibian assets are available at the moment. So if we have to invest 50% of our portfolios locally, a large chunk of that is going to go to government bonds. Rising yields on these bonds means prices are going to fall. So if you've bought already, you'll probably see pressure on those asset prices and not performing as well as, let's say, the South African counterparts. The Namibian equity market is relatively small. I think we've got 11 listed counters. So there's only really so much you could do in that space. We're hoping to see MTC list this year, so there'll be at least 12 companies. But it's not a very, very broad range of options. You also have your due listed counters, but these have been limited to 10% of that allocation. So basically all that really leaves you is bonds. And I think it's probably in government's best interest to raise the local asset requirements, because they'll create artificial demand for their own debt. And I just don't see that deficit being covered any other way. But yes, yields will come under pressure, and I think your man on the street, the asset allocation is not going to be a long-term asset allocation. It's going to lean more and more to fixed income, and I think it's going to have a negative effect on returns in the long term.
Of course, one of the major players, probably the biggest asset manager in terms that could fund that type of thing, would be the GIPF. In the past, we've seen, especially the last year, 18 months, government and the GIPF being extremely defensive when there are questions about or questioned about the impact of, for lack of a better term, being forced to invest more locally. So yes, it is worrying that there are those concerns, and ordinary people who've saved for their entire lives must be worried about something like that. Dylan, there are people who say that government has no other choice. What it's doing now is the only thing it can do. Do you agree with that?
I think making a change now will be very, very difficult, but it is a discussion we have to have. I really like the idea of Finance Minister Tito Mboweni in South Africa, where he said we should start with a zero-based budget. We should really start from scratch and see where we need to allocate funds. Seeing the expenditure profile flat over the next couple of years is good, but I think we need to do much more. We really need to start taking drastic steps and looking at where we're spending that money to make sure that this is a sustainable economy going forward.
Yes, and what is, I nearly said what is tragic, but what is concerning is, yes, COVID has put emphasis on these things, but all these issues, it's not discussions that we're having just the past year. The SARCO issue, the wage bill, I mean, we've had these discussions year after year after year, and there hasn't really been a lot of change, or we've not really seen drastic change from government in terms of that expenditure. I think it's Moody's. Yes, it was Moody's who brought out a credit analysis of government recently, and where they said that government can't really make a call on civil servants because it's politically too sensitive or too hot. What do you think would be a workable solution for the wage bill?
That's a very, very difficult thing to say. I think at the moment, the current way we're doing things is probably the best. Just freezing the waste ball, making sure that open positions aren't filled, seeing a bit of attrition, people leaving the workforce. I think we could also look at lowering the retirement age even further and just trying to get as many people off the payroll as quickly as possible. But making drastic steps in that direction is very, very difficult, especially when you take who your major employers are. It's health, it's education, it's defense. Letting go of these people is not always easy, but I think at this stage of the game, we're really being forced into a corner. We really have to look at our structures, our payroll.
Dylan, we can still we can talk budget the whole day long, but I think we'll have to call it a day for now. But we're looking forward to some more insights from you in the future. Thank you very much.
Thank you so much.
With us in the studio is Mario Poolman. He is the head of customer strategy at Nedbank Namibia. Good day, Mario, and welcome.
Hi, Joe. Thank you.
It's quite interesting to have this conversation with you because we started out many moons ago together as journalists, and here you are in the financial sector. How did that come about? What interests you about banking?
Wow, yes, yeah. So I remember the days way back when we all got started together. So it was also strange for me to come here and to have a conversation sitting on the other side. Well, it's a long journey. I think, it was just one step in front of the other. I've always had an interest in business. I went to study after school. That didn't work out so well. So obviously there was a lot of student debt. And the first thing that I could think of is, how do you settle this debt? And it spurred commercial orientation, and I was always thinking, how would I get to running a business or be part of running a business? And the springboard or the ladder in my head was always, okay, I need to get into marketing, which would get me closer to business. But to get into marketing, I need to get into PR. But to get into PR, I need a journalistic background. And that was literally just how things unfolded. And what's great about being in the financial services industry is banking isn't just a business, it's a business that deals with a lot of other businesses, so it always remains interesting.
Yes, it's quite an ecosystem on its own, the whole banking sphere. Mario, you've been at Nedbank for quite some time now. You have also got your MBA, and you are now the head of customer strategy at Nedbank Namibia. What does a job like that entail?
Well, firstly, it's quite broad, and I think it comes off a wave of businesses in the world recognizing that they should be more customer orientated. So traditionally, a couple of years ago, up until 100 or 200 years ago, you had production-driven business systems. So they would produce a product and they would go to the market and say, we have X. And we will, and please buy it from us. And then you had this whole marketing era where you said, okay, lots of us have X now, but my X is better. And that's where the marketing era came. And subsequently, I think people realized this authenticity of really putting the customer first, not just having X, but having a specific solution tailored to customers and moving towards that. And then aligning your supporting functions and your core business to providing what the customer really needs as opposed to what you can provide. And that's where this whole customer orientation business comes from. And my position as head of customer strategy was also born from that. I mean, Nedbank has come through a long journey where we've become increasingly customer oriented through time. And my responsibility specifically was to help drive that and accelerate that process.
Yes, because as the whole financial services industry and probably other industries too evolve, especially now in the new normal, the voice of the customer is becoming increasingly more important, and just that customer segment of a business becomes quite a cutting throat industry. You've got to keep up.
Yeah, definitely. And you also have to know where to filter out the noise. So with the proliferation of social media, which effectively gives anyone a platform, the voice of the customer is extremely loud. And many times they're there for a good reason, but sometimes, it's just people who aren't really as informed as they should be. Now, who do you listen to? So, you have to complement what customers say also with what your own research and investigations reveal. Because there are many times when customers really don't know what's good for them and they think that this would help them. I mean, in the financial industry, it's there's a very good example. Credit is something that as a bank you need to give out responsibly. But if you give someone the opportunity and no responsibility of repaying their debts, they would just continue along that road. So a customer would feel, just give me more, it doesn't matter what you believe the risk is. But then there's also where you need to come in and say, well, given data, given what we've seen in the market trends and where things are moving, this would suit you better than what you think would. So also managing expectations of customers, I think, is a crucial part of that whole exercise.
Coming back to more specifics around your job, you have embarked on quite a few new initiatives in the past few months. Tell us a bit more about that.
Well, actually, in the last couple of years, Nedbank, especially Nedbank Namibia, has been on a digitalization journey. And I like to point out to my colleagues and to customers, if I get the opportunity to talk to them, that there are all these digital banks out there and all these innovative fintechs coming out globally, and they're saying we're going to revolutionize the banking industry. But what also happens is that traditional banks like Nedbank, we also recognize that things are changing and customer expectations are changing. We've essentially built a digital bank in parallel with a traditional bank. And if you look at what is out there for Nedbank Namibia, our core banking system is electronic. It's a database. Yeah. And the way that you interact with that database is through digital transactions. And even when you walk into a branch and you ask someone there to execute some kind of transaction for you, that person then just goes to a digital system and captures the transaction electronically. So basically it's your choice that the front end could be digital, the one that you engage with can be digital, or we could give you this screen of people, but they then interface with the digital in any case. So that's the one part. So we've been on this digitalization journey for quite a while, and it's accelerated in the last couple of years. And now we've moved into the innovation space. So with the Money app in Namibia, we were the first bank to allow you to manage your cards. So block it and release it, or without having to cancel the card or call someone. We also we had the best user interface because we recognize that a lot of the banking apps, not just in Namibia but globally, are product driven. So what I mentioned earlier, where we just provide you with something, you need to figure it out. So we just changed that around with that app and said, how would someone engage with an app, and then figure out how we deliver that service to them. And I think the latest and greatest in terms of innovation was this whole exercise where we partnered with the local fintech, the Today company, and they brought us Pay Today, but they also brought a new service called Identity Today, which on its own is basically a system that allows you to verify the identity of someone. And in the bank, what you would do normally to achieve that is you would look at someone, you would have their ID, you would say, okay, I see this is a person ID, and I would have a copy of that ID and stamp it and say, I verified this. And that process takes labor. You need people time. People need to travel, make time, come to a bank. The banker needs to sit there and not make a mistake. The ID needs to be clear. So this process basically reduces that whole exercise to a matter of minutes, and if you're quick enough, to less than a minute. So with them building that platform, we've integrated that into our processes. We jumped through a number of legal hoops. We had consultations with regulators, and we said, if we embed this into our business rules and processes, we want to be able to open accounts. And after a number of trials, we managed to get there. So now essentially, with Identity Today being part of our process, you're able to open an account with a selfie.
That's unbelievable.
Yeah, so the Identity Today process is premised on facial recognition. And there's artificial intelligence in the background that, verifies are you a living person? Is there some tampering with the ID? Lots of security technology behind that. And that really just allows you to, wherever you are, take the phone, snap a selfie, take a picture of your ID, answer a couple of questions about the product you want, and there you have it. So literally that process takes 3 minutes. So you can now open your account, you can start banking electronically, but obviously if you want a card, you'll still need to come into the branch. We can't teleport it just yet.
Not yet.
Not yet. Yeah.
Mario, that's absolutely fascinating. Especially a person like me moving on in life slightly can only marvel at all these new innovations coming out. The immediate future, how does that look in terms of what you guys are working with at the moment?
Well, so if you say immediate future, the thing that is top of mind for me is COVID-19, which is inextricably linked with the economy. So, as I mentioned to a colleague earlier, the unpredictability of COVID injects that unpredictability into the economy. But what we find is that there are pockets that are performing well and pockets that are not performing well. And what you also have to realize is, although there are certain areas of the economy that are affected in real terms, like tourism, people can't come here, there are also areas that are affected in psychological terms. People are afraid to spend their money. People are hoarding their savings and not spending that. And that has another repercussion. So when you look at that, in the immediate future, from a banking perspective, what we're doing is we've always been very prudent in terms of assessing customers and their ability to repay their finances. That will continue to be, that will probably increase in scrutiny going forward in this time. So we need to help you understand your situation fully so that you're not in a position where financially you're going to run into trouble. But then we're also very much focusing on those areas and individuals and trying to identify them who have the ability to contribute to the economy. So remember, it's in everybody's interest that the economy starts moving or gains traction. And a bank's responsibility is allocating value from where people don't necessarily use that value to people who want to use that value. And if people are holding on too fast to their money, not spending it, that's a problem. So for us to help identify opportunities and to facilitate deals and transactions in the market, that's pretty important for us, because for those people who have the means at this moment, the economy is potentially very favorable. The interest rates are the lowest it's been since independence.
Exactly.
So just with home loans, the current base rate is 8.5%. In the last 30 years, it was 14%. So what that means practically for a person buying a home today, with the same value of home that you need to pay off, that installment is discounted by about 30% today.
Yes,
so
absolutely.
for the people who have the means and the capability, the opportunities are there, and we're trying to focus on that. And then we're also trying to help where we can, being involved in society and the community to help drive things forward. From a technological point of view, COVID has really, emphasized the need of technological service. So we've always known that this is going to be the road for banking. But as with many other businesses, I'm sure you've heard that they said that COVID didn't, introduce digitalization; it just accelerated it.
Absolutely.
And that's the same thing that's happened with us in terms of the innovation parts of our business.
Mario, fascinating to talk to you. Thank you very much for visiting the studio, and best with all your efforts.
Thank you. Thanks, Emily.
Thank you. Thank you for joining us in this week's Business 7 program. We'll see you at the same time, the same place in 2 weeks' time. Stay safe.